Hello Accounting 101 students. In this video, we will highlight some of the information in our Chapter 4 student review slides that you can find in the modules area of our Canvas website. Chapter 4 has several major areas of focus. The first area of focus is the accrual versus the cash basis of accounting. In our financial accounting class, we utilize the accrual basis of accounting. Then we go through some of the steps in the accounting cycle, which include adjusting entries, the adjusted trial balance, preparing the financial statements, and closing entries. The accrual basis of accounting indicates that transactions are recorded in the periods in which the events occur. So this means that the revenue recognition principle is applicable because revenues are being recognized when the services are performed, and it does not matter if we receive money from our customers right away or if we receive cash later through accounts receivable. We also follow the expense recognition principle, which indicates that expenses are recognized when they're incurred. So when the company receives the benefit from that cost, even if cash was not paid. So you can have some expenses that you pay for right away, and you can also have some expenses that you will pay later through accounts payable. This is different from the cash basis of accounting, in which the revenues are only recognized only when cash is received, or expenses are recognized only when the cash is paid. And you'll notice that this is not in accordance with the generally accepted accounting principles referred to as GAAP. And this is best gone through with an illustration from our textbook. So suppose Fresh Colors paints a large building in 2016. So in 2016, they incur and pay total expenses for the salaries because the employees worked on that painting, and the paint costs because we needed to purchase the paint prior to performing the service. So it doesn't matter when we actually pay the salaries or pay the paint cost, because in 2016 we performed the service. We should recognize those expenses in 2016. And we notice that the company bills the customer $80,000, but they do not receive payment until the following year, until 2017. So we follow the accrual basis of accounting in our financial accounting class, which means that revenues need to be recognized in the year where we perform the service. We did the painting in 2016, so we recognize the revenue in 2016. We purchased the paint and our employees worked in 2016. So those expenses were utilized to generate those revenues that year. So we're going to include the expenses of $50,000 also in 2016. And we'll notice that our net income is reported $30,000 in 2016. And because nothing happened in 2017, there is no impact to the income statement. And this makes logical sense because the alternative is the cash basis of accounting. And what happens with the cash basis of accounting is that the company will record the revenue when they receive cash from their customers. And that happened in 2017 versus the expenses were paid for in 2016. So there is a mismatch. Your net loss of $50,000 is reported in 2016, whereas a net income is reported in 2017. And you can see that there's no matching between the revenues and the expenses in the accounting period in which the work was performed. So another major concept that we have in this chapter is adjusting entries. And they ensure that the revenue recognition and expense recognition principles are followed. And the adjusting entries are required every time a company prepares financial statements, and you will notice a trend in your journal entries. There will always be an impact to one income statement account, so it will have an impact to either a revenue or expense account, and you will have an impact to one balance sheet account. So when we go back to our accounting cycle, we first start off by analyzing business transactions, journalizing those transactions and posting them to the general ledger, and preparing the unadjusted trial balance. So after we put together the unadjusted trial balance, we're going to journalize and post adjusting entries. So this is the step that we are in our accounting cycle. And this chapter continues with the adjusted trial balance. And then from the adjusted trial balance, the company will prepare its financial statements, starting with the income statement, then the retained earnings statement, followed by the balance sheet and the statement of cash flows. But as part of this process, the company is also going to record their closing entries to close out the temporary accounts of revenues, expenses, and dividends that are only reported for a short period of time in order to prepare the post-closing trial balance, which is necessary so that way they can start the next accounting period with $0 in revenue, $0 in expenses, and no dividends to record the items on the income statement and retained earnings statement separately for each accounting period. So next we have our types of adjusting entries. I have an entire handout that goes over these adjusting entries in a lot of detail. So we have prepaid expenses and unearned revenues, which are categorized as deferrals. So expenses that are paid in cash in advance, and they are recorded as assets before they are used or consumed, are referred to as prepaid expenses. And they're kind of the opposite as unearned revenues. With unearned revenues, we receive cash in advance from our customers before performing a service or providing a good. Then we have our accruals. So we have accrued revenues. So this means that the revenues are earned for services performed, but they're not yet received in cash and they're not yet recorded. So at the end of the accounting period, we need to do an adjusting entry just to record those revenues. And then we have accrued expenses. Those are expenses incurred, but they have not been paid in cash and they have not been recorded. So at the end of the accounting period, we need to assess what accrued expenses we need to record. With our prepaid expenses, this means that the cash payment occurs before the expense is recorded. So our initial entry includes a debit to prepaid expense, which is an asset account, and a credit to cash because we are paying for that prepaid expense in account. Over time, we will use up that cost. So there might be a passage of time, for example, with insurance, or through use if we prepaid another asset in advance. So our adjusting entry would be a debit to an expense account, and you'll want to be more specific with the title of your expense account relating to what you had prepaid, and then you're going to credit prepaid expense. So if we look at our T accounts, our prepaid expenses are going to be reported as a debit because prepaid expenses is an asset account. Over time, as we use or consume that prepaid expense, we're going to be reducing the balance that is prepaid and recording the expense as a debit. So some examples include insurance, supplies, advertising, rent, and depreciation. And if you didn't make this adjustment, that means that your assets would have been overstated and your expenses would have been understated. Then we have unearned revenues, which means that we receive cash that is being recorded as a liability before the services are performed. So the cash is received before the revenue is recorded, and this happens when we receive cash in advance from our customers for rent, airline tickets, subscriptions, or customer deposits. So our adjusting entry is going to reduce that liability account and record revenue when we have earned that revenue. So we have some information regarding your unearned revenues, and some examples were previously noted, but if you don't do this adjusting entry, that means your liabilities will be overstated and revenues understated. Then we have our adjusting entries for accruals. So those are for revenues for services performed or expenses that were incurred. And for our accrued revenues, we need to record an adjusting entry because we have not received cash, but we have earned that revenue. So for accrued revenues, all there is a debit to the asset account, which will typically be accounts receivable, and a credit to the revenue account. And then we have an example in your student review slides that you can read through. But the next topic is accrued expenses, which basically means that we need to record the expense regardless of when we have paid for it. So we have not paid for it yet. So we need to record the obligation as a liability, and we need to recognize the expenses as a debit. So some examples include interest expense. So we have some examples in our student review slides. Salaries and wages expense, and we have another example in our student review slides. And typically you will have your accrued expenses that will have a debit to an expense account and a credit to a liability account for the amount that is payable. And this is pretty typical for interest, for rent, and for salaries. And if you don't record this adjusting entry, that means that your expenses would have been understated and your liabilities would have been understated. So I have a slide that has a summary of the basic relationships, and this is part of the process. So once we record our adjusting entries, we're going to post them to the general ledger and use it to prepare the adjusted trial balance, and we want to use that adjusted trial balance to prepare the financial statements. And at the end of the accounting period, companies are going to transfer the temporary account balances in revenues, expenses, and dividends to retained earnings, which is going to be included in the stockholders' equity accounts in the balance sheet. So basically, we're going to take our revenue accounts and our expense accounts, and we're going to record those amounts to the income summary and then move those amounts to retained earnings. And then we're going to take our dividends amount and update our retained earnings with dividends. And the purpose of the post-closing trial balance is to prove the equality of the permanent account balances that the company carries forward into the next accounting period. So all of the temporary accounts are going to have a $0 balance. And last, we're going to just summarize the accounting cycle. So you can see that we start off with each of these steps in order to go through the entire accounting cycle in each period. Thank you for taking the time to watch this video, and I hope you will utilize all the resources we have included for our class.